that music and all of those legal words means we're ready for another episode of the Halftime Report. Love the Halftime Report on Monday. I specifically love having this be my coach slot. Matt's always here on the Halftime Report, and they always have a different coach come in every day of the week. I love Monday because I would tune in anyways, because I love when Matt breaks down the sector charts. I love top-down analysis. I love when we break down those sector charts. We're going to break down the sector charts for you after we go over broad market action. And then, of course, at the end of the show, talk about another Gino gem from the great Gino Poor. Pleasantries as always, Matt. Matt, how was your weekend?
My weekend was fantastic. The Miami Dolphins got another win, and my tackle fantasy league it's amazing. My tackle fantasy league is going in the same path that the Miami Dolphins are on. It might be because I have some Miami Dolphins on my tackle fantasy league, but it was fun. It was fun watching some football over the weekend. It was fun taking a little bit of break from the market until Bitcoin decided to crash over the weekend, and then that kind of ruined the relaxing weekend. But it was a good weekend, and I'm very excited to be here with the community to break down the market activity today and later on tonight. Chucky, I get an opportunity to sit down with our YouTube community at Tackle Trading and introduce to them a strategy that I absolutely love called the covered call. And I'm going to do a very obviously Tackle Trading 101, covered call for beginners. If you are new to covered calls or new-ish to covered calls, we're going to have some fun tonight as I teach people and introduce individuals to the covered call, why we do it, what do we do with it, how do we do it. So we're going to rock and roll tonight with another edition of the Tackle Trading 101 series on covered calls tonight. So definitely come and hang out with me tonight as I give a presentation on covered calls.
Listen, looking forward to it. And it is obviously, it's Beanie Monday here at the Halftime Report.
I don't own a beanie.
So. You didn't get the memo.
I didn't.
You didn't get the memo, but Gino's rocking his Rams beanie. I guess, when you got on a 3-game losing
I got to
streak,
get you guys tackle trading beanies. Like, what are we doing here?
Dude, if it is a, black
it's got to be
a
thing.
Beanie,
it's got to be a thing.
Gino, how you doing out there in California this morning? And you're on mute.
No. Don't tell me he's on mute. He's talking about the Rams.
You're still on mute, yes, Gino.
Keep him on mute. It's fine.
You're still on mute.
And that's all I had to say, really.
There you go.
Well, you really want to talk about
on the broad market and now.
Yeah, let's jump right in. We're not going to talk about my ESP, my fantasy football team. No, not this weekend. Not this weekend.
But you got a Gino gem for us at the end of the show, sir?
Oh, man, do I ever. This one's good.
Gino, I thought your last
What were the last ones?
If you thought last one was good, I'll let you know when there's a bad one, okay?
All right, you tell us. Next Monday.
Okay, just a little heads up.
Terrible. Hey, Matt, listen, we got healthy market intraday action. The market, stalled for a few minutes at the open, but then has been pretty good up. But we've seen this song and dance, right, Matt? We are in day 7 now. Mm-hmm. Of market volatility.
Oh man, really wide I don't watch CNBC a lot. Are they running day 7 markets in turmoil?
The market's in turmoil down.
We know that's the buy sign, right? When CNBC's rocking markets.
When they start doing markets in turmoil, then fear is in, and then you break out the Warren Buffett. Buy when others are fearful. Be greedy when others are fearful.
It's a good telltale. It was a great pandemic sign. It was a great pandemic sign. It was like literally the bottom 3 consecutive times. But will this prove to be the bottom in this short-term volatility that the market's been going through over the last couple of weeks? I don't know yet. I'm certainly leaning towards that. I posted some of my technical thoughts within the Tackle Trading Discord channel earlier this morning. But let me kind of break it down. And the pattern that we've really been tracking here in the market is the volatility up and down nature of the marketplace. And this is a pattern, Mark, that quite frankly, let me go back a little bit in time just to maybe give everybody a reminder that this is not the first time the market has went through some increasing volatility, increasing up and down nature of the marketplace. I remember my first and up and down nature of the market where I felt like I had a really good edge on the marketplace, and then I just got whipsawed, whipsawed, whipsawed. And I still remember this, and I'll remember my entire life because it was tied to the European debt crisis, and you were getting a lot of geopolitical news. And right here, this up and down nature of the market was really kind of the first. And don't get me wrong, I'd been trading for 6 years at that point, so I'd seen many times like this, but this was one that just really stood out to me because of how it personally impacted my emotion to the market, because I felt like I had such an edge. I felt like everything was crystal clear. I felt like I had a good read on the market. I felt we were overreacting to the European debt crisis. I felt like the ECB was going to come in with Captain America on its side and say, we're going to, increase liquidity here. And, it started, up, boom, down, boom, up. I mean, it was just really rapid price cycles. And you see it quite often, quite a bit. And you really want to give this time, unlike me back then, you want to give it a little bit of time to smooth out. And so when you're looking at this market now, fast forward 10 years, when you're looking at this market, obviously not the volatility we were dealing with 10 years ago as we were navigating the European debt crisis 10 years ago, but you still have that same up and down nature of the marketplace. And if you'll bear with me just a moment, Chucky, as I bring out, what the people want, Chucky, and they want the epic pen here. So give me just 1 second, right? You want to get the epic pen so you can see. You see that nice little volatility cycle, the up and down nature right there. You see a very similar one right there. And then you're looking at this one currently right here. And so the market goes through this quite often is one of my points. But the second point is while it's in the pattern, you're going to get faked out. There are times because of the way the news cycle works and the way technicals work, and quite frankly, the way the buy the dip mentality works, is there's going to be some fake outs. But what you want to see is you want to see two different things here. You want to see volatility slow down. That's what you want to see, because volatility is the kryptonite to technical analysis. You want to see that slow down so that you can get a better, easier read. Remember the analogy I gave last week, Chucky, was, it's like the dam just broke, all the water's coming out, it's rapid, it's crazy, it's scary, it's overwhelming. But what we really don't know is where the real damage is. And what we don't know yet, because the volatility, thus the water, has yet to subside, we don't know where the low price is yet. Well, as volatility starts to shift a little bit, and it has just a tiny bit, you can kind of see it down over here, and it's to the far right, but you can kind of see it slow down a little bit there. You've seen it slow down just a little bit, but what we haven't seen yet is for the market to actually break out. Now, in the previous two examples, when you're looking at this volatility pattern there, as you tested the 50, and when you're looking at this volatility pattern here, what you saw a couple things was you saw ultimately you saw one break down and you saw one break out. And so we haven't seen that breakout yet. We haven't seen it. We're still tracking 4,600 in the market. Yes, the market looks like it wants to break out right now. The market looked like it wanted to break out last Friday before it didn't, and it came back down intraday. It looked like it wanted to break out last Thursday. It looked like it wanted to break out last Wednesday. We've seen this before. That's why we track these very important technical levels that you can start to see some degree of confirmation. And so you're going through a very similar technical volatility pattern. The news is the news, right? The news last time was really about Delta. This time it's about Omicron. The example I gave in 2011 was during the European debt crisis, and when Greece came out and defaulted on their debt and had to get billions upon billions of dollars in loans from the IMF, the ECB, Russia, and the United States just to stay solvent. And so you have a market that will go through this over and over and over again. Patterns are similar. The news cycle might be a little bit different, but we're in the pattern right now, and what we really got to see is we got to see a breakout. Now, one key difference technically here, because I'm tracking very similar technically, 4,500 to 4,600. Over here you had the ranges, over there you had your ranges. Now we're looking at step one, volatility to subside a little bit. We're in the very beginnings of that, Mark. It hasn't subsided to the levels that maybe we want to technically yet. If you look at the VIX here, you'll see the VIX kind of coming down just a little bit, but certainly heightened volatility. And Gino, you're the option expert here. You love the VIX, Gino, and I know you're chewing on some breakfast over there, so I apologize. But Gino, when I'm talking about volatility subsiding and the VIX still elevated, would you agree that we're still in enhanced volatility, but yet if it is going to start topping, this is what you want to see?
Yeah, exactly. Because the VIX is overstretched, and I was talking about this on a report, the newsletter. Is what happens is when the VIX gets this high, what it's signaling is options are getting expensive, and like any insurance product, which options are, when your insurances start getting expensive, you can't buy as many products that you want to insure. So it's hard to enter a lot of new positions if you know because the insurance is too expensive. I mean, you might be able to afford the Ferrari, but you can't afford its insurance. You just don't do it. So here we see at levels of 30 and higher, it doesn't hang on to that very long. So we do need either the market to grab footing and to go back to bullish to bring down the fear, or people just to flush out and stop buying options. So usually what happens is the prior, you usually get people, hey, you know what? Listen, let's start buying quality positions. That's really what it's about. Quality, meaning you don't have to insure them as much. They're quality positions. They're more of investments. And you'll see this pull back. But yes, definitely overstretched. It doesn't last long here, Matt.
Yeah, and so when you're walking through reversal analysis, Mark, it takes some time. It just does, especially when you give up mentally V-shaped recoveries. Like when you're outside the need for V-shaped recoveries, like you don't have that same emotional take. And so you really kind of just allow that patience to kind of work out as it navigates the steps in a reversal. And step one, you got to see volatility subside. You know, when I technically talk about it, I talk about slowing momentum. I talk about slowing momentum in trend. I talk about slowing momentum in candle. I talk about slowing momentum in pattern. You can also look at that very similar as you look at say the VIX. I just feel like if you track it on the S&P, and this is why I like the S&P far more than the VIX, I just feel like you're a little bit in front of everybody else that is just tracking the VIX. And so when you're looking at that, step one, you got to see slowing momentum. We're seeing just a tiny bit of it, Step two, you got to see some double bottom, double top. When you're looking at this from an intraday perspective, coming down to the 30-minute chart here, you are starting to see a little bit of double top, double bottom action. Double bottom over here at 4,500, double top over here at 4,600. And so you got a couple things that I feel are fairly important to the market. Number one, you look at that trend line right there. You see that 30-minute trend line? That's the current trend line in the market that I feel is very, very important. And that's one of those steps that breaking back out above that would certainly give the buyers a little bit more confidence. But again, remember what we were talking about last week. It's not about one level of confirmation here in the market recovery. You got to have additional confirmation. You got to see this market not just break out and trigger like we're in a bullish uptrend and we just want to take advantage of momentum. You really got to see this market start to work itself up from an intraday perspective with a series of higher highs, higher lows before you really start getting confident. Because again, when you're looking at the broad market's down just a hair. We're testing the 50-day moving average, but we're not that far off the highs. But when you're talking about all the stocks in the market, there is a tremendous amount of stocks, especially in the disruptive innovation areas, the Cathie Wood ARC type series, or when you're talking about growth in general, that has just absolutely been blasted over the last month or so. And so you got some very low prices on certain areas of the marketplace that I think, if this does prove to be ultimately a buying opportunity off the 50-day moving average in the S&P, I think it's okay to give the intraday charts a little bit of time to solidify themselves, to see some consistency, because we always say this in reversal. If the reversal confirms, you're going to have a pretty decent and pretty easy market for the next trend. And so I think it's okay to wait for additional confirmation within a volatile bearish type environment, before we start really kind of triggering on the top side. So the first thing we're looking at technically is really kind of a violation of this 30-minute trend line going down. You can see it, it's faint, but you can see it over here to the far right. It's trying right now to break out of that. We've seen a couple fake outs here though. You saw a fake out right there, came right back down on some news. Remember, news is a killer here. It is a killer here. And so news in a volatile market will have a tendency to violate technical parameters. Once again, that's why I want to see multiple types of confirmation here and not just something I'm looking at because I want to get into a trade. And so number one, we're looking at that 30-minute trend line. Number two, and again, it's a little bit choppy, but I think if you really kind of understand where these intraday levels of horizontal resistance are, it could help you as you navigate this yourself as well. Number one, I talked about it all last week, but 4,600 has proven to be a horizontal resistance level. So step one, we got to break out of the intraday here. Step two, you got to reclaim that. Now, once you reclaim 4,600, you could see that what I've been talking about is that series of higher highs, higher lows from an intraday perspective. And as that consistency starts building out intraday, you start putting a lot of pressure on what I feel is an even more important zone. And that's right in that 4,650 zone. And you see that right where that 20-day moving average is right here. This is a key telltale difference between the last two patterns when it broke out versus this pattern here. When you're looking, when we were tracking this one here, it caught up to the 20-period moving average, but it never could get above it, got blasted against it. That downtrend persisted for another 3-4 weeks until once again, you started seeing a true reversal analysis. This is not a true reversal analysis. This is a breakout against an intraday resistance. This is a head and shoulders formation. And so once the 20-period moving average caught up, you see how important that was, that downtrend just persisted another 3 to 4 weeks until ultimately what happened? An increase of support, a violation of the right shoulder, reclaiming that 20-day moving average. And then once it got above the 50 there, it was clear selling for an entire month of trading. It was a very easy trading environment.
You know, that 20-day, let me just for one second, that 20-day moving average was the go signal last time, and coupled with the other patterns though, right?
Yeah, it wasn't just one thing. It was the combination of technical environments kind of coinciding with one another. But I would definitely say the reclaiming of the 20 was a very important step in that.
And I want to bring in Gino here for a second. Now, Gino,
can I just finish my 4650 real quick? Okay, so when you're talking about that series of higher highs, higher lows very quickly, step one, you break out of the 30-minute chart. Step two, you reclaim 4,600. Step three, you start working consistently into that 4,650. 4,650 is a number to really kind of pay attention to because number one, you see the old chop. This is the old chop before this nightmarish volatility type pattern has persisted. That 4,650 was a very, very important zone of support. It certainly could play a role as resistance. And ultimately, when you come out to the daily, ultimately, we're also looking at that 20-period moving average, which just so happened to come in very, very closely against that 4,650 handle as well. Once again, no reversals clean. It's going to be choppy. But these are the levels that we're tracking to see some consistency in the market.
You know, Gino, one of the very first things, I met you about 15 years ago, Gino. One of the very first things I think out of your mouth was the 20-day moving average. How do you, I mean, I remember, like, I remember it clear as today, 15 days later. I mean, I met Gino Poor, and he starts talking about the 20-day moving average. He probably didn't even say hello or this or that. He's like, you know, listen, that 20-day moving average is when because I was new to the markets, and Gino and Party, this first thing ever. How do you use as a trader to give an importance of why you've been around a long time? Yeah. I've heard you say many times, Gino, that you're a buyer when things clear the 20, right?
Exactly.
And you use that kind of as your own personal line in the sand.
Yeah, exactly. It's my line.
Why is that the case?
That's my personal rule, my line of demarcation. Like, when do you buy? Of course, triggers are so important. Like, triggers are, where do you buy? Where do you get out? Because if you can predict where everybody else is going to buy, that's a big thing. You know what I mean? I mean, it's like, wow, Goldman Sachs is going to buy at 46.50. Imagine if Matt was onto something. He said, you know what, guys, the algorithms are going to buy at 46.50 and a half. But not, only if it gets there. Only if it gets there. If it gets there, here comes the volume. They're going to buy. If you knew that data ahead of time, you'd know exactly where to place your trigger. If you knew where everybody was, and that's how it was on the trading floor back in the day on the open outcries, you'd look for the guy with the most money. Where's he buying at? Where's he selling at? And really, isn't that the whole game? Is like, where is this thing going to actually catch ground and take off? Where's this thing going to make the decision to go up or down? Where's that trigger point? Because too many people are just trigger happy, like bottom fishers. They're like, oh, I don't want to miss the bottom. We're way below all these moving averages. Let's just buy now so we don't miss out. And then the market hits its head on the 20 and sells off. So what I found out, Mark, years ago, like when I first started trading, just like you said, is most traders that trade from technical analysis, that do scans, algorithms, they scan for stocks that are outperforming the market. That's number one. And have have strength, but the moving averages that they all have in common, some people use the 8, some use the 5, some use the 9. Most of the people will say the 20. Most technicians will say, I use the 20. And from back testing, when stocks are above the 20, they usually stay there and they use it as support and resistance. So if you had to find a moving average that acts as support and resistance most of the time and actually holds true, it's the 20 EMA. So the 20, whether it's simple or exponential, has the best history of being good support and resistance. So think about it. If I'm bullish, I want to make sure it bounces off the 20. But in a situation we're in now, if it's got the best history of being support and resistance, why would I try to buy under it? Because if it's got a strong resistance, I know that if the demand can clear that resistance, it has to be strong. It has to prove itself. It's got to be like a good offensive line against that defensive 20 right now. So once it breaks through that 20, it's got to be tough. That means a trigger above 20 is a lot stronger than a trigger below 20. So yeah, you can say, well, I'll wait. If it hits its head on there, I'll get out. That's fine. It's just your odds increase dramatically once that stock or the index gets above the 20. And one of the reasons why, I'm not going to get into all the reasons, that's a 2-hour discussion, but one of the other reasons is it triggers algorithms. Algorithms start saying, hey, you know what? Above the 20. And also it starts popping up on my screener, and it starts popping up on a lot of screeners because there's a lot of traders that only trade bullish stocks if they're above the 20. In fact, that's the first 2 screeners I look at for our stock and options report. Is it has to be above the 20 or it doesn't even pop up on my screen. So, trigger points above the 20, there's a lot more buys than trigger points below the 20. I should have just said that in the beginning. You know what I mean? I should have said that sentence. I've been done.
I certainly agree. I'd say a vastly high percentage of short-term trades are made above the 20 versus below the 20 because you're talking about all trending bullish conditions are typically above the 20. Bullish retracements can't happen outside of reversal analysis unless they come first into the 20. And so the 20 also represents really good. And you're also just simply because the 20 period moving average is tracking closer to the current price than say the 50 or the 200.
Yeah, exactly.
You're also simply going to get a lot more opportunities on the 20, and thus the data is going to be a little bit more overwhelming there versus the 50. I'd say when you're talking about moving averages, the consistency of the 20, the 50, and the 200 on the simple side, the consistency of the 8 or the 9 on the EMA versus the 13 on the EMA, those are really widely used market moving averages. The 8, 9, 13, the 20, 50, 200. Outside of that, like when people come to me and they're like, oh, I got this great moving average system. If they don't use market known moving averages, I literally could care less.
Right. And also, Matt, like you were showing on the 50 there, the ES and the SPX index itself, see how it's like sitting on top of the 50? A lot of times it's, like I'm saying, I don't ever not only bottom fish, but if the internals are strong and you're an investor and you like the price, yeah, of course you don't need to use the moving averages. But as far as swing trading, some of my short-term like position trades, 3 to 4 weeks, yeah, I'm looking for those. Sometimes there isn't anything above the 20 when you're coming out of a bear market, and you have to resort to other ones. But it's just nice to know that that is a pretty big barrier. But look how you're looking at that 50-day moving average right there on the ES. That's interesting. I was talking about this earlier to somebody, that this 50, we call it the sticky 50, right? It is a good support and resistance, right? Your 50-day. And then when you look at the NASDAQ, the NDX, it's the same thing. The NDX is sitting right there on the 50, right? I mean, that's not coincidence. It's almost like, I like to describe it as the markets do this dance where they're trying to align and they come apart, but most of the time they're aligning. And it's not really a coincidence. The S&P is touching the 50 and the NASDAQ. And I was kind of wondering about this a few weeks ago, is now when you go to the diamonds or the Dow, it's also touching the 50. It's just, it's below it. You know what I mean? So now the Dow's hitting its head.
Well, not anymore. The reopening play today is proven to carry the Dow a little bit relative strength.
Yeah. So it's kind of like, was the NASDAQ and S&P waiting for the Dow to meet up with it? They both grabbed hands at the 50 and now they're going to go up. It's kind of like a little dance, right? Where they're all trying to align. They were separated 2 weeks ago. And now they're, the Dow and the Russell were just nosediving when the NASDAQ and S&P were holding up. But now they're more in line. And I like it more in line.
Can I speak to that for a second? I don't think it's anything that they're trying to get aligned. I think the market's trying to understand what the news is, and they're trying to price themselves appropriately to the current market conditions. And when you're talking about the gravity of the sell-off in the Russell, the gravity of the sell-off in the Dow Jones, you're talking about two fairly economically sensitive indexes in the Russell 2000 and the Dow Jones as well. And so when the news cycle is hitting, and that news cycle is due to, oh my goodness, we have Omicron coming to town, and it could come with increased regulations, increased fear. We all know the pandemic playbook. Well, that fear is going to happen from a cyclical area first and foremost. And so I see this as, especially in the sell-off in the Russell 2000 and the Dow Jones over the course of the last few weeks, I see the sell-off exacerbated more based on the news cycle than anything technically. Yeah. It's a matter, if this is the bottom, it's a matter of which ones recover faster. And because Omicron is becoming, I don't want to say rear view mirror type analysis, but Mark, would you agree that it's rear view mirror to a certain
like as we've been
extent?
talking, the trend on Omicron has been very positive. The cases, Dr. Fauci, even in the last 24 hours, has been saying, listen, we're still waiting for data, but it's very encouraging. World Health Organization, reports that it's spreading. And you might see lots of headlines saying Omicron spreading, but the cases themselves appear to be very, very mild, which is wonderful news. And market, over the weekend, that became consensus out there. Like right now, our best guess in scientific community, more contagious, lot less severe. And we're still waiting for vaccine tests to see how it does against the vaccine. But, those reopening play, you go look at Delta Airlines, Carnival Cruise Line, your hotels. We're seeing huge, massive movement in these plays. Now, there's still a lot of headlines ahead, but, it was all, you see substantial moves up, moves up on that general thing. Dow's, small caps overperforming. Anything else to add on that? Because I want to get to the other market.
Not on the broad market. I just want to look at
the I did want to add on the broad market. Did you look at the $ ADD, the advanced decliners? Healthy in the morning. I always want to watch this in the close though. The $ ADD is the advanced versus decliners. This lets us know, this is something the first thing I look at right now. And we're healthy today, but when you look at like a 15-minute of that, we're open strong. I want to see this trending up into the end of the day, because if you go back 4 days there, or Wednesday, when we hit the high of 2279, right in the middle of your chart there, 2279, we started off strong, then we nosedive. I want to see exactly the internals, just one of them, like the ADD, I want to see them hold up throughout the day. And that's just telling you that stocks that were up are staying up, you know.
I agree. And I'm also willing to bet that if we close above 4,600, that's going to improve.
Oh, definitely. That would be, those two signals would align perfect.
Yeah. All right, Chucky, I just want to spend a little bit of time on the broad markets because we're in this technical scenario, and I believe technical analysis is more important right now than any other form of analysis.
It really is. I mean, and when the patterns, it will take a minute. You're patient. Let's go look at commodities and then into sectors, Matt. Just a quick look on crude oil. I mean, we're going to see a lot.
Yeah, I'm gonna do this fairly quickly, Chucky, because there's really nothing to see until we see patterns emerge here from a bullish perspective. Right now, you're looking at a bearish downtrend with increasing volatility in the trend, but decreasing volatility within the pattern. That's going to give you a little bit of mixed signals. I think those two things have to align. They can't align, starting with me with the double bottom. Right now, you're looking at this as a bearish retracement with resistance at $70. Once again, if this is a buying opportunity, we're going to see a double bottom, or we're going to see it reclaim at 70 and patterns emerge. At this point, you're looking at this as a bearish downtrend, and the pattern a bearish retracement with resistance at $70. Any bull opportunity, I think, is too early. Chucky, you track oil. Gino, you track oil.
Yeah.
Agree or disagree?
No,
totally
it's just,
agree.
I don't buy into falling moving averages.
No.
No, that's not a winning system.
That's another. You don't buy it.
No, that's not a winning system.
I mean, think about it. It's the exact, like when oil was on its uptrend in August and September and into October, would you sell into rising moving average? I'm going to short, I'm going to short.
The average price is going down and you're swimming upstream.
That 9 is climbing. I'm going to short into that and just hope. No, you wait.
Wait for the moving averages to smile. At least wait for the shortest time frame moving average to give you a hint of a smile. Because right now it could be a frown.
If you want to go broke trading long term,
Yeah.
buy into falling moving averages.
Buy into falling moving averages, and thus we'll say the exact same thing on gold right now as it's testing the 9 EMA. Gold needs some work to do as well. I don't see anything we're going to add to the conversation today. You're fighting up against a cluster of moving averages. You got support at 1760 by 1720. Gold's going to take some time to work out its technical parameters, but really don't see anything outside of that in the gold or the crude oil market. Obviously, Bitcoin had some news coming, not so much news, but really had a technical trigger. We closed underneath that very important 55,000 level on Friday. The selling continued. Now, I will tell you, there's a lot of people tried to wrap some type of news item that they could understand price action responses to. I'm telling you, for me, this had nothing to do with brokerage firms over leveraging themselves. That's been the case during Bitcoin when it was driving from 10,000 to 70,000, back down to 50,000. That news cycle's there all the time. To me, this was a technical event when you triggered underneath 55 and you saw an increasing volatility on the overnight action. We see this in the stock market all the time. A technical event is triggered on the short-term price action. You close underneath 55. Well, in the stock market, what happens? You get the European, you get the Asian, you get those markets start opening up. The volatility continues. This looks to me like a continuation of the 24-hour cycle. It simply shuts down because Friday in the actual futures market, it shuts down. When you actually trade in crypto, it's a 24-hour market. This to me looks like an exasperated run to the 200-day moving average. I think the real action starts happening now.
Yeah. It's going to take a minute.
Oh, no. It could take a minute. It could take a day. It could take 10 days. We don't know. What we do know is the last two times we retrace, one in a bearish downtrend, one in a snapback bull flag. Both played true. The 200-day moving average did play a role in those upward movements in price. And so I don't think you can discount the area on the chart you're at. You're right there hovering against 50,000, which is a significant whole number. You're right there hovering against the 200-day moving average. And yes, you got to look at this as one big red candle down. That is an increasing volatility. That is a very scary thing from a technical perspective in the immediate short term. But I also think you got to think about this long term, and long term. You see that 50-day moving average on the weekly chart? You're kissing up against that. Same way you were kissing there, same way you gave a little bit of kiss low there. That's something that's going to play a role, in my opinion. That coincides right where the 200-day moving average is on the daily chart. And so I do think there's going to be some battle lines drawn. It's not a battle I personally want to fight. It's not a battle I would recommend to my good friends to fight out there, but it's something to track, because if you see those buyers or those sellers start to come in one way or the other here, I think you could have some trades in a short term. I do think you could have a fairly decent trading environment, but not right now. I think you got to wait for the volatility to subside.
You have any earnings for us before we get into second round?
I know it's Monday. I get a reprieve from all things earnings, but we do have some on the docket this week. We do need to track very quickly. Oracle, Costco, Broadcom, Lulu, GameStop, Chewy, Restoration Hardware, and Toll Brothers are just a few of the names we're going to be tracking this week from an earnings perspective. But earnings, obviously, earnings season ended a few weeks ago. The new earnings season will start in a month or so. Right now, we got a little bit of reprieve from an earnings, but obviously the market's got its other things it's focused on right now.
Indeed, it does. All right, let's get into sector. Let's break this down. Now, you're seeing broad-based strength today, but you're seeing some interesting charts, especially in the defensive area of the market. It's just popping right now. But where do you want to start? Do you want to start cyclicals, growth, or defensive?
I personally always go growth, cyclical, and defensive. That's just kind of my process here. And so when you're looking at this, I'm gonna break it down a little bit from a rankings perspective, and then I want to bring in Gino. Gino, I'm gonna go through all growth, and then kind of add your commentary. Then I'll go through cyclical and so on and so forth.
Okay.
So let's take a quick peek at technology very quickly. Seeing a little bit of chop, trying to fight for that support level. We have yet to close underneath that 165. Unlike its parent, the NASDAQ closed underneath 1600, came all the way down into the 50 there. When you're looking at technology, I do think you got to be slightly impressed that it is yet to close underneath 165. 165 certainly acting as a support. You're looking at overall in the short term, because you now have pivot confirmation both on the top side as well as on the bottom side. Top side slightly north of 170. Bottom side support right there about 165. You got a short-term neutral condition against the backdrop of a longer-term bullish uptrend. Because of the short-term neutrality, you certainly are going to see a downgrade at tackle trading. We downgraded 5 given the short-term pivot confirmation to create a neutral environment in the short term. That's going to see a downgrade of 5 in technology to 25, which is our highest rated sector still at tackle trading as we're navigating the volatile, choppy markets. Highest rated sector, technology. But once again, holding the short-term support level, you got to be impressed. And then when you look at the backdrop of the long-term chart, I'm sorry, that's a bull flag against the long-term chart. There's not a lot of fear in that long-term chart regarding technology. The only question is it a short-term buy opportunity at 165, or are we going to see a little bit more volatility down to the 50-day? We're going to have to be a little bit patient and wait and see, and thus the downgrade there. When you're looking at discretionary, which is the twin sister of technology, you're looking at a little bit of M formation, double top, double bottom, testing 200 right there north of that 50-day moving average. Because of the volatility of the last few weeks, because of the M formation, you got to be a little cautious here as we fight for support in the discretionary sector. Another downgrade here, given that we fell against the 20-period moving average last week, and thus confirm that short-term neutrality, because when you're coming into last week here, you're still seeing that as a little bit of an increase in support against the backdrop of the previous one. And so you're still looking at that as a slightly bullish short-term environment, given that support did technically increase and resistance did technically increase as well. And so that changes, though, when you see that violation last week and you come all the way down into the 50. it confirms that short-term neutrality at that point. You got to be concerned. You see that 5-point downgrade once again. You got to look at that now at the 50-day moving average and kind of the horizontal $200 level as well. And then the last is communications, and communications has been a dog at tackle trading. Our rankings are in the bearish territory for 2 consecutive weeks. This has been the lowest rated sector at tackle trading for quite some time now, and we've said for a very long time, and very long time for short-term traders, like a month ago, we've been saying that this sector is not a sector to really kind of participate in, and it's not a sector to really kind of, you know, even track until you start to see the bottom of this sector really start to play ball a little bit. And that bottom of this sector, you're talking about the AT&Ts. Well, AT&T is firing off the last 3 days, but guess what? It's firing off into an increasing bearish trend, which is now a bearish retracement. You got to see it fight back up against 24 before you start to see AT&T really have that bear stop out day. When you're looking at Comcast, CMCSA here, the bottom of the market, and again, we're looking at just the bottom of this market to see if we can see some stabilization, and thus the market and thus communications in general finding a bottom. Comcast here has been a problem child, trying to find a double bottom analysis right around that 50 zone. Once again, a very, very choppy retracement, reclaiming the 20-day moving average, and you're certainly seeing a little bit of volatility shifts here. When you look at Disney forming a little bit of bearish retracement. And so I just wanted to give a couple examples because there's about 20 of them right now in the communication sector. But you're going to see in the media today, yes, and 2 days ago, and most likely tomorrow as well, communication doing great. You're going to see in your scanning of the top gainers, communication doing pretty good. I think it's a little bit of a false flag until we start to see a resistance level of any note get violated. Simply because you see an upward movement in price does not mean it does not mean it's the bottom. It simply means it went up. That's all it means. In the greater picture of things, i.e. the trend and the pattern, you're looking at a trend in communications that is increasing momentum to the downside, which means the upward movement in prices are also going to be exacerbated against historical price action. This is a nothing burger to me in communications until we see volatility subside in trend, until we see patterns start to develop. And the patterns that absolutely have to develop here are traditional reversal patterns, double tops, double bottoms. We haven't seen that. Right now, we have an increasing trend to the downside with a more volatile bearish retracement that is yet to even test the 9 EMA here. I think you got to be patient here in communications. And let me say it again, I think you got to be extremely patient here in communications. And the patience is allowing that technical parameters to play out so that we can get better signals. That is the growth area of the market from a technical perspective. Coach Gino, what do you have anything to add to the aggressive sector conversation?
No, I do not. Actually, the growth, the communication, talk about being aligned. The communications is the laggard of the market. And when you look at that, and it does stand out on our gridiron, that's why we put it on there. It's so far in the negative. Do I expect a bounce here? Possibly. But yes, it is the most disconnected of the sectors. And I think, Matt, like you said, it's from the small, the growth stocks, smaller caps, basically. But if you take those out of there, it's not too bad. There's actually some good setups in that sector. You just got to.
If I only leave Google in the sector, we might be able to get a good setup in there.
There you go.
Yes.
Yeah.
I think Cons needs some time. I think it needs some time. It's throwing a temper tantrum and it's acting like a little spoiled brat.
You got to be selective.
Needs to go put into the corner and think about your behavior so that you can change it in communications. Let's talk a little bit about the cyclical areas of the market as they are firing off a little bit here today. Energy last week was a maintenance mode for us, and it's not because volatility has shifted. It's really because support and resistance kind of held here. you know, when you're looking at energy here, you could see some bottoming price. We got it ranked right there at the 40 handle. Short term, you're dealing with a little bit of bearish downtrend, which means we got to see a breakout of resistance first and foremost. And I think the resistance level that myself and many are tracking is right around that 57 handle. When you're looking at 57 in energy, that's slightly north of the old previous all-time high right there. But it's also coincides very nicely with this horizontal support level. Couple it with a little bit of resistance, you could see it reclaiming some clear air above 57. So keep an eye on the energy space as it does navigate the 20-day moving average, the 50-day moving average, as well as that horizontal resistance level at 57. Once 57 is reclaimed, you could see a little bit of shift in volatility and a little bit of a bullish uptrend at that point from an intraday perspective. So keep an eye on that one. When you're looking at basic materials was leading the charge. But then you saw a violation in the last couple of weeks, one against the 20-period moving average and the other one against the 50-period moving average. That's a little bit concerning. And even though you are seeing a big upward movement in price in the material space today, this still has to be a little concerning given the fact that volatility is the exact same as today as it was 3 days ago. The only difference is one went up and one went down. And so I think you got to like this. Don't get me wrong. I'm not trying to throw cold water on a good hit parade happening in materials up 2% today. And it certainly could prove to be a very, very good buying opportunity as you try to navigate that weekly pattern here. Good upward movement in price, good increase in resistance, really good increase in support here on the weekly chart as well. And so as the daily chart takes a little bit of time to settle down the volatility, that weekly chart looks really, really, really good. And so that certainly could prove to be a good buying opportunity. You got to like the upward movement in price here today. But once again, volatility being so important to me in my analysis during these choppy waters and during choppy markets in general, I'm not seeing a shift in volatility yet. I'm just seeing a shift in price action. And so I like the weekly chart. I like the bigger perspective on the materials in general. And I like the daily price action too. Just in the back of my mind, I also remember the last 2 weeks in the material space, and it wasn't exactly an easy market the last 2 weeks. And so want just to see a little bit more of a consistency in technical analysis in the material space as well. Industrials and finance. Industrials saw a 5-point downgrade down to the 45 handle, down to the 50 handle as it's now stuck in broad-based neutrality, both against the short-term chart, also the long-term weekly chart. You're really back into that same degree of neutrality that we saw the industrial space as well as the Russell 2000 kind of hover against for 8, 9, 10 straight months. And so right there at the 50 handle on industrials for us to represent the current trend and the current pattern in industrial. And then finance has had a little bit of difficulty finding its footing over the course of the last month or so. A series of lower lows, lower highs. Again, seeing a very similar pattern here, underperforming the S&P, underperforming some of the other cyclical areas of the market. And even if you see a violation today, you're still staring down the barrel right here at $39, and you haven't even tested the very important combination of the 20 and the 50. And so you got some work to put in here in the financial space before you see any good patterns develop from a short-term perspective. Gino, do you have anything to add to the cyclical conversation?
Not much. It's just that, yes, these are more in line with the rest of the market. I do like to see this sector rotation, and I'm trying to guess where oil's going to go from here is tough. But if you can guess the energy sector, guess the dollar, it makes it so much easier. And that's for another time and day because we get into that on the commodities report. But no, actually, cyclicals, I'm just kind of interested to see what's going to strengthen up here and who will be my favorite going into next week if we find footing. But until then, I'm just going to sit back.
Well, and it's, again, these weekly charts look pretty healthy today because on a Monday, they're all going up and the last couple of weeks has been choppy, volatile. that weekly chart really isn't told until Friday. Would you guys agree with
That's
that?
true.
No,
That's so
not
true.
and that's the thing is like, and if you find yourself like second guessing, I knew to buy the button. Don't play that game,
Right.
because like
Listen, those people said that last week and they all regret it.
yeah, like it is. Well, the Omicron is encouraging. We're in a Fed blackout period, and the higher it goes, right? If it stalls, those fears reignite. Listen, manage your existing positions and be patient. I mean, there's plenty of money to be made in patient time. We'll see how the industrials navigate that falling 20 there.
Well, and these sector conversations are so important because as the volatility does subside, and it will, when the dam breaks, the water eventually does subside, and the volatility will subside here as well. When that does, that's where those true buying opportunities really start to stand out. Because right now, yeah, people are trying to race to be the first and to race to pick the bottom. But for a trend trader, for a standardized swing trader, they don't care about those battles. They just want to ride the train once the victory is declared. And so once the volatility does subside, what starts to happen, because as the volatility picks up, everything moves in line together. Everything does. It always happens that way. Everything, it might take a turn, but it all moves in the same direction. As volatility subsides, what happens is you start to see separation. And where you see the separation first is you see it sectors. Right now, you're looking at the cyclical areas of the market and you're saying, look at the performance today, up 2%, up 2.5%, up 1.5%. You're right, doing really, really good. The question is, can they continue to do really, really good because they got their asses handed to them the last couple weeks when they weren't doing very good? And so we need to see more than one day here. At least I do. At least I do. At least I do. Especially in a day where the news cycle is good for cyclicals. I need to see that go up a little bit more because once again, you're looking at industrial here. You got to love the fact that 100 held. Absolutely, 100%. But again, support holding is a vastly different conversation than the importance of a resistance level getting violated. And right now, that 105 stands out to me.
It certainly.
And then finally, but not last, the defensive areas of the market.
Defensive areas. I mean, even
definitely not last. Definitely not last.
Last Friday, and it was telling that when the market was having its thing, defensive areas were holding their own on Friday.
Yeah, well, and Chucky, that stood out to us at Tackle Trading as well as we were talking about these sectors in the scouting report meeting. You're looking at downgrades. Like if you look at the combination of downgrades in the growth areas, you're talking about a 20-point total downgrade in growth, 5 in discretionary, 5 in technology, and 10 in comps. When you're talking about the entire cyclical areas, you're talking about another 20-point downgrade there. 0 in energy. Energy maintained its pattern, maintained everything, so it maintained its 40 handle. 10-point downgrade in materials, 5-point downgrade in industrial, 5-point downgrade in finance. In the defensive areas, you had 3 of these sectors that actually maintained their parameters from the previous week. You had staples maintain at 35, you had real estate maintain at 30, and you had utilities maintain at 40. No downgrades there. The only downgrade you did see last week in the defensive areas of the market coming into this week was a little bit of a downgrade in healthcare, but that was more so for us catching up to the price of healthcare than anything else, in my opinion. When you're looking at the price performance today in staples, obviously the maintenance mode played off. Now you're tracking the resistance breakout. Staples having a really good day here today, up 2%, very similar to a lot of the cyclical areas. Real estate, another area of the market that we maintained last week, up 2%, once again threatening a breakout. Our highest rated sector in defense is real estate. And when you're looking at both cyclical and defensive, the highest rated of those bunch is the real estate area. And that's looking at a little bit of a breakout potential here in real estate. You got to like that. And when you're looking at utilities is a gobbled mess of nothing until it breaks out. And now it is absolutely breaking out. And look at the volatility from last week, guys. Look at that volatility. Look at that increase in volatility. And we didn't downgrade last week in utilities because support held. I didn't see that big of increase in volatility, quite frankly, and we didn't violate a support level. I had a very difficult time, and so did others that tackle trading, downgrading this area of the market despite the increase in volatility, because again, support at 66 held, so that had to play a role in that. And then you had that 200-day moving average right behind it. I will tell you though, defensive areas are playing ball here today. Both real estate, utilities, and the consumer staples all doing really, really good. Healthcare, even with the upward boot in price, healthcare is underperforming everything else. I still maintain the downgrade is viable here, especially with it underperforming the rest of the broad market. And as the broad market is picking up, I should just keep talking, because the first thing I started talking when I put that 30-minute chart, we broke out and we're just climbing and climbing and climbing from there. But you're really seeing cyclicals climb, you're seeing defensive climb, and you're seeing a little bit of stabilization in the growth areas. And so one day it's positive. Let's see some continuation here.
And it's you know, when volatility strikes, charts can get sloppy, overextended.
Very fast.
Because both to the downside and the upside. I mean, what are you supposed to do with that utilities candle, right? I mean,
well, as a trader, nothing. As an investor, I mean, you're like, yeah, my Duke Energy's doing okay.
My consolidation,
Yeah.
old ED is breaking out. And, a couple nice things. You got any other news, Matt?
No. Journey through the sectors is what I wanted to do here today, and I am excited for another. And again, for me, Mark, and again, maybe this is just me, but for me, when it comes to the markets and when the markets become extremely news driven, it doesn't really matter what the news is, in my opinion. It just matters that the market sees it as important. For me, it's about the charts in these moments in time. I honestly, it's about the charts.
And that is the hilarious thing, isn't it? That in the midst, when news cycles hit, the charts become even more important. Because
the charts tells us the collective mentality of the entire marketplace without actually talking to them.
Yes, absolutely. All right, listen, it is.
And it
Monday.
tells us a hell of a lot more about truth than what they say on CNBC.
Markets in turmoil. Matt, the next time markets are in turmoil, CNBC, I don't care. I'm saying it now. I'm going to go buy 100 shares of the SPY.
Well,
The next time they run a special.
CNBC, just come watch the halftime report. Just come watch the halftime report.
But
we know you do it. So
these charts are going to play out throughout the week. And of course, when we get that, like Matt nailed it. Like Matt, the last time we had market volatility in August and September, Matt nailed it. Like he saw it coming. He saw the development, saw the signal. He's my go-to on, judging the volatility here and breaking it down. He says, be patient. I'll be patient along with most prudent individuals.
Get it ready though. Like get it ready, because again, you're going through the same cycle, right? I don't think we're looking at a month from now, Mark. Not at all. I think there's key levels technically we have to track this week, and if those key levels are affirmed, I think we could be go time far quicker before we were last time. But it's just a matter of going through that process and sitting your butt in the chair and tracking that intraday data, because the one thing you can't speed up is the 30-minute chart. It's going to take 30 minutes to develop.
Indeed. Listen, the end of Monday, Gino gem time. At the end of every Monday's halftime report, Gino breaks down an indicator, breaks down some aspect of monitoring trading. Sometimes it's a trade management tool on Thinkorswim. He breaks down, some focus of an indicator or a tool you can use in your trading, the management of your investing portfolio. He does it every Monday at the end of halftime report. It's always a great segment for even those very, very experienced. It can be quite illuminating. So Gino Poor, I turn it over to you.
Yeah, I've got another Gino gem for you. And this one is not anything new. It's been around. It's just, I don't see a lot of people using it that should be, because with volatility jumping in there and volatile markets, I'm going to look at something we've looked at in the past, nothing really new. Let me bring it up, and we bring down the Gino gem sign here. So we talked about average true range as an indicator. What that is basically, a stock trades over 14 days. What can you expect the average daily range to be from the low to the high? It's the average move of a stock. How much does it move a day? And average true range is a popular indicator. It's a lagging indicator, but it does give you some kind of indication on the volatility of the stock, how much it moves. Kind of like, when you look at how much did a stock change today versus yesterday, that's one thing, but what's the percent of that change? So I'm going to introduce a new ATR. Well, it's not a new ATR. It's been around. I just don't see a lot of people using it. But back when I started trading back in the day, I did notice a lot of day traders using it and swing traders that trade stock, not so much option traders, but stock traders. And what this indicator is it's not the change of the stock or the range. It is an ATR, but it's the percentage of that ATR. So let me give you an example of what I'm talking about. So ATR, if I click on CAR here, CAR, and by the way, I just grabbed some random symbols off our stock report. This is off the Tackle Trading Stock Report. There's a lot more than this, but this is how, one of the ways, and I do this quite often, I look for a certain ATR. Like when I'm swing trading, this is just my rule. I want an ATR between 1.0 to about $3 because my stop loss, I don't like it farther than $3. So I usually put my stop loss this far away. That's one of our rules from our step system. We do one ATR away. Now, if you look at Lamb Research down here, look at the ATR, 21. That means if I'm using that rule, I want, like if I go to Lamb real quick, if I get my trigger point here, right above the swing, a 21 ATR means I got to go way down here. Now that's a pretty deep ATR and a big mover. Now, the big mistake here, and that's why I'm bringing up this new indicator, which has been around forever, everybody just forgot about it, is this doesn't mean Lamb Research is more volatile than CAR. So give you an example here, and I'm going to give you a couple examples so it becomes clear. CAR moves 137, and I've got it smallest to biggest. So where's the biggest mover as far as points? Well, on this list, Lamb Research here moves $21 a day. CAR only moves $1.37. So which one moves the most? Well, of course, Lamb Research. And then you're like, well, that's pretty, it's pretty volatile. Not really. You got to look deeper. Now, how about these two? Do they move similar, Bro and ACI? Let me see. Here's ACI and here's Bro. They both move about $1.44 a day. But what you have to look at is this. $1.40 a day on a $66 stock is completely different percentage move than $1.44 a day on a $36 stock. So the indicator that I add to my ATR is the APTR. The APTR is what percentage move does this thing move per day. So if you look here, yeah, they're both $1.44, $1.40 ATR. They both have about the same $1.40 move. But check out ACI. That's a 4% move a day. So which one do you want? Do you want a stock that moves 2% a day or a stock that moves $4.21? So if you're a trader and you have a playbook, think about it. If I'm putting $2,000 in a stock, do I want to invest $2,000 in a stock that could make me 2% or 4%? So basically same ATR. But as you can tell here, ACI is 2 times the volatility. 2 times the volatility. So if I'm trading stock, I want the most bang for my buck. I want to know that this stock is, so how do I find out? Just by looking at, here's a mistake most traders make. If you're position sizing and you're going to put $2,000 in any of these stocks over here, Do you put it in the one that has the biggest daily move or the biggest percentage move? The answer is percentage. So I bring it over here. I sort it by who's the highest percentage. Actually, JXN, Jackson Financial. It's only $1.74, which is very close to, but it moves 5% a day. If it's moving $1.74 on average, that's a 5% move a day. And if you're trying to hit goals and make a certain percentage, you're going to get more bang for your buck on JXN than you would, let's say, MMC. So think about it. What ATR do you trade for swing trading? So for me, I personally trade between 1 and 3, and I look for the highest percentage move because that one right there stands out. These two right here stand out. For me, these would be my 2 top picks for swing trading because they have close stop losses. They're under $2 here, and they have the biggest move per day. So I'll give you a couple more examples, and you can see real quickly. It only take 2 seconds. I got 2 stocks here. Which one is going to give you more bang for your buck? The $1.74 ATR or the $1.40 ATR? Well, right away you'd say the $1.74, but it's only a $39 stock. You add the APTR to it. Actually, JXN is more than double. It's 2.5 times the bro stock right there as far as return per day. Okay, here's another one. Looking at Jackson versus MMC, you can see MMC is $3 ATR versus that's almost double the ATR. But once again, you look at the APTR, actually JXN is 2 times MMC. You can see it's way better percent move per day. It's a percent move, like a percent change. Last example, looking at these stocks here, some common names. Amazon, 97 ATR. Coca-Cola, 93-cent ATR. These are all big names. Looking at here, which one is going to give you most bang for your buck? Most people would gravitate to this because they think it's a bigger ATR. But honestly, if you look at the APTR and sort it by that, your biggest move is Twitter right here. Twitter moves 4.6% a day, and it's only a 227 ATR. And that's even bigger than ConocoPhillips. And if you look down here, then 93-cent, yeah, that's a small ATR, not too bad of a percentage move. It's the same as Walmart. Like Walmart, 2.5 ATR versus a 93-cent. Actually, they're the same percent move here. So take your pick. But if I'm looking for best bang for my buck, this one right here, by far Twitter for $44, I could buy a lot more shares than I could buy Amazon. So for a stock trader, you get more bang for your buck here. If I had to pick between these 5 on Twitter. So looking for which one's going to move the most by percentage. That's the ATR. That's the average percentage true range. And it helps weed out which stock is actually more volatile. ATR is a false illusion. It just tells you points, not percentage. And that is another Gino gem, something else to add to your watch list there. Something else you can use also if you're a stock trader, looking at our stock report. Look for the one that's going to move the most. And if, do your position sizing correctly and give you the best return. That's it.
Gino, like once again, you break it down. So you did a great job teaching there. Interesting material, slow, methodical, teach it out, lay it out. A stellar Gino.
A lot of people never heard of that, right?
No, and that's the thing about Gino Gems is like, for new and experienced traders, there's little tidbits of knowledge in there. All right, markets rallying right now. It's going to be interesting to see how it plays out in the coming days. I mean, you're seeing broad-based everything. Poor Bitcoin just holding its own after its rough weekend. Everything else having a party. It's going to, in these broad range candles, it's all about chart development. Matt will be here all week breaking it down. And in addition, Matt will be here tonight on the YouTube channel. Matt, just spend a couple more
I live
seconds.
on YouTube. That's what I do. I just hang out on YouTube. No, I will be with the team all week long, navigating the markets, as I'm always with the team all week long, navigating the markets in the halftime report. And we're going to break it down, obviously, intraday style, live on these charts this week. A couple things. Number one, you got to like the fact that number one, as a bull, you got to like the fact that the market came out of this weekend, especially with the crypto crash, to respond with a bullish mentality. I think that's a very positive step in the right direction. Number two, breaking out of that 30-minute chart, this was really kind of the second time in this volatility cycle we've done it. The first time got snuffed out pretty quickly, got beat back down within the intraday, within the exact same time frame. That was last Tuesday, Wednesday. This time, you're seeing a little bit more consistent price action following the cash open. You're seeing a little bit more consistent price action after you broke out of that 30-minute chart. And now you've broken out of 4,600, which was the key level, that first key level that we identified that we're going to track. Now let's walk up the stairs here from an intraday perspective, and definitely stay with me all week long in the halftime report, as I will have Coach M on tomorrow to navigate the markets with you. But before we do that, I'll be on YouTube with our community tonight, talking to them about the covered call and another edition of the Tackle Trading 101 series, which is an introduction to all things trading and investing. A couple weeks ago, we did swing trading. A couple weeks before that, we talked about different types of funds. This time around, I'm going to be rocking and rolling with the covered call, because Chucky, over the next 2 weeks, I'm into the Tackle 25 and the research and design for that system and for the stocks on both the Tackle 25 covered call list, Dirty Sexy Money, Poor Boys covered calls. That's my month of December. Every month of December, gonna kick it off with a Tackle 25 covered call webinar here tonight. We'll have a lot more to say about the Tackle 25 covered calls as we get to the end of December and as we release the new edition at the first trading day of the year every year. And so we got a lot to talk about with covered calls this month. We're going to kick it off with an introduction to covered calls as we navigate into some more advanced covered call commentary and education later on this month.
I'm looking forward to all of it, Matt. Genuinely looking forward to all of it. Listen, the last 10 days have not been boring. I doubt the next 10 days are boring either.
No.
It's just it's waiting for opportunity, right? It's waiting for opportunity and waiting for confirmation, waiting for this to play out. And listen, I'm happy sitting on my hands as it plays out. We all have existing exposure. Just be careful out there. Be careful out there. Any last thoughts, Gino, before we sign off?
Yes, if you have not read the newsletter, please go into the newsletter. If you're not a pro member, jump on our trial and check out the newsletter. I've had a lot of comments. I'm not just saying this, that people live by my newsletter and really look forward to it. It helps them they learn something, they plug in the market, it saves them hours. We put about 6 to 10 hours every week into that one newsletter. Also, to leave you with the final words, look for quality trades, good patterns that are not news-bound, quality trades, patterns that aren't broken, and not quantity. Manage your quality trades, use stop losses.
I love that. The less is more. I love that. Quality
Yes.
trade, that's a great thing. And my final thought is we love you all, Tackle Trading community. Pro members, new members, not yet members who check us out on YouTube. And if you want to see what this amazing community is all about, great people are traders, part of our community, just the best salt of the earth people you'll ever meet. Go to the store tab at tackletrading.com and sign up for a 15-day free trial. Come give us a shot. We're out. Have a wonderful